It's been 2 months since the collapse of the Francis Scott Key Bridge in Baltimore. Estimated insured losses from the tragedy could end up being about $3 billion. If that's the case, it would make it the largest marine insurance loss ever recorded, with property, marine, aviation, transit insurance premiums likely impacted. For more on the far-reaching effects of this incident in the insurance world, we want to bring in Bruce Carnegie-Brown, the chairman of the leading insurance and reinsurance company Lloyd's. And Bruce, thank you for being here today.
Thank you for having me.
It's been a couple of months, and we know those early estimates of $3 billion were kind of what was being kind of eyeballed at that point. I know it's still a long way for all of this to be completely investigated and found through, but does that sound like an appropriate level to you, around $3 billion?
That feels right. I think the physical damage amounts are reasonably easy to calibrate. The bridge, the ship. The developing claims are all around business interruption for the cargoes trapped in Baltimore port that have been slow to emerge. And I think they were originally planning that the port would be fully reopened by the end of May, and I don't think that's going to happen. So further claims will develop, but I think $3 billion is a pretty good approximation.
I mean, to put that in context, $3 billion is hard to get your head around, but that's more than even Superstorm Sandy caused in terms of maritime insurance losses.
Yes, I think that's right. But in the scale of overall losses from hurricanes, this is still quite small. I mean, Hurricane Ian, I think, going through Florida last year had insured losses of about $50 billion US. So this is very much manageable for the insurance industry. And the good news for our customers is that almost all aspects of the disaster are insured.
Right. Is this something, I mean, it seems like it's gone smoothly from the insurance perspective at this point. Will it mean big losses for insurers and reinsurers?
Well, it will. It will be a very large loss. Our estimate for the Lloyd's of London insurance market is somewhere between $600 and $900 million net. It will take a little bit of time for the liabilities to crystallize because there's got to be an investigation into who's responsible. But I'm pretty confident that in aggregate, more than $3 billion will be paid out by the
history of Lloyd's is kind of amazing. It goes back to, was it a coffee house? Actually?
It was a coffee house.
It was there when the ships would come in, and this was trade, global trade at the time. It had to be managed somehow. It had to be insured somehow.
Well, it started really as an exchange of data in a coffee house, and then, of course, people trying to lay off the costs of their cargoes and shipping as it moved around the world. And from there, the market developed. It got properly incorporated in the 18th century. So, yes, nearly 325 years old.
And how are things going right now in the insurance industry? We know, writ large, when you look at insurance, it's a better scenario when you're dealing with higher rates instead of zero interest rates because you can offset potential losses in the future with gains that you're making in the markets right now. How does that work for you right now?
Well, the real offset is that both sides of the balance sheet are working for the first time in 15 years. So all of the money we retain to pay claims is actually earning us a return. But of course, that's slightly offset by inflation. So the liabilities are going up because of inflation. So really the interest rates you earn on the time deposits and the bond portfolios really offset some of the inflation impacts we're seeing in claims. But underlying prices have been improving across the market for a reasonable period of time now, getting back to more sustainable levels. So from an underwriter's perspective, it's actually a good time in the market.
So you can write policies. You've had the situation where state regulators and authorities are saying, okay, it's okay to raise rates to try and recoup some of the losses you were making from inflation?
Well, we don't play in the admitted market where the regulators intervene. We're the largest player in the surplus lines market in the United States, where we can choose our own pricing, and what we're finding is that pricing is looking pretty competitive. So we continue to be the leading provider of surplus lines insurance to U.S. customers.
What's it look like in Florida right now? I just saw a report last week about how hurricane season is expected to be the highest risk, the most number of hurricanes that we've seen because the water temperatures are already so warm. What do you think as an insurer or a reinsurer when you look at that?
Well, the conversations we have with governments at state and federal level in this country, but also internationally, are very much around trying to build more resilience into the economy, because insurance really only works when it's protecting against unexpected outcomes. If the outcomes are expected, then, of course, the premium at some point equals the claim and the model breaks down. So this is actually trying to persuade people to be a little bit more careful about zoning and planning permissions. Florida has been benefiting from inward migration from the rest of the United States States for more than 40 years, and it tends to be more affluent people that move there with expensive assets and expensive livelihoods, and they all want to live on the coast.